moving to our next speaker, has been close to EBAN for over 20 years and influenced the setup of EBAN in the very early days with John Berry and others. He is Professor of Entrepreneurship at the University of Glasgow and previously was at Strathclyde and Southampton. Over 30 years research on business angels and investment activity, he has had much influence on policy and perspective. So today we've asked him to join us, and he's just published a report on the coronavirus economic crisis, the impact on VCs, venture capital, and high growth enterprises. And he's done this for the Joint Research Council, JRC, of the European Commission. So it's dead current. So Professor Colin Mason, you're most welcome. And please give us some highlights and also some upside.
Thank you very much. Well, let me try and start my indeed for that introduction. I've got a big clock in front of me to make sure I don't exceed my 50 minutes of allocated time. I'm very grateful to Peter Cowley for inviting me to speak, particularly as Michael has said, I was very much involved with the origins of EBAN in the late 1990s. I've been involved in doing research on business angels for a much longer time than I think in the early 90s, and even before the term was introduced into the UK. So let me start. Well, we know we're seeing a huge contraction in economic activity at the moment. Output is falling, businesses are closing, and there are many businesses that are kind of subsidised at the moment. Will not open again once furlough schemes and so on finish. Jobs are being lost, unemployment is rising. Somebody made the interesting observation that this is not like any normal economic recession, which tends to be Darwinist. It culls the weak businesses. This crisis is not just unproductive businesses that are failing. Good businesses are at risk as well. I think everybody agrees that economic recovery will be driven by entrepreneurs who start and scale innovative businesses, particularly innovative businesses that are providing solutions to the problems that this present crisis is creating for consumers, for business, and for government. Now, innovative businesses, particularly scaling up businesses, typically have this kind of phenomenon of the valley of death. They're investing ahead of revenue. So typically, they're going to need equity finance to develop the products to scale up. But I think there's unanimous agreement that the economic crisis arising from the coronavirus is resulting in an immediate reduction in entrepreneurial finance by all the different players, by business angels, by equity crowdfunding platforms, by seed venture capitalists, by venture capital funds. And as statistics begin to emerge, I think this very pessimistic view is sadly being confirmed. And so the concern is that if we're seeing a contraction in risk capital, this is going to have a dramatic impact on the ability of entrepreneurs both to start businesses and particularly to scale up businesses, with then implications for how quickly the economies of Europe and globally recover. So this is where business angels come in. We all know, I'm speaking to the converted here, we all know the importance of business angels, the key role they play at the start of the entrepreneurial pipeline. Angels are typically the first external source of funding in a business. And as angels have got together to invest as groups rather than as individuals, so the collective financial pockets are deeper, so they can do more than just an initial funding round. We know too that the importance of angels is not just their money, it's their expertise that they bring. We know that most angels are either successful entrepreneurs, successful cash-out entrepreneurs, very often serial entrepreneurs, or they've been on boards of large companies. So their expertise is critical as well. And then the angels also provide the deal flow for venture capital companies who provide the finance for those businesses that are needing to scale up. And people have talked about this funding model as analogous to a relay race. The angels run the first leg and then pass on the baton to other funders. So the whole point is that business angels are critical to the entrepreneurial-led economic recovery. If angel funding is constrained, there are severe implications. Here's a quote from it was an article in Sifted, I think. If angel investors were to slow down, it would have a massive impact on the startup economy of Europe. Indeed, if angel investing breaks down, you break down the whole pipeline of development. So the question is this happening? Is this pessimistic scenario happening? Well, what I'm going to draw upon is information I've kind of culled from conversations with business angels, angel group newsletters, webinars that angels have participated in and shared their thoughts, financial media, and some ad hoc surveys. And all this suggests that this negative scenario, sadly, is likely to come true. Now, first thing to say is it's actually very difficult to present a coherent picture. Angels are heterogeneous, so not every angel is experiencing the same situation. And the evidence that I've reviewed isn't telling a totally convincing, a totally consistent story. Moreover, I think there's a time before we actually see the real effects of the crisis in angel investing, because a lot of the deals that have been done in March and April and so are being picked up by the statistics were deals where the investment process started pre-COVID. So the negotiations, the due diligence was all done before we had to move into this virtual world. So it's only kind of the statistics in Q2 and Q3 will really see the impacts of angel investing. But what we seem to be seeing is, on the positive side, the majority of angels are continuing to invest, but most of them are focusing their investments on their existing portfolio, keeping them afloat, extending their runway, helping them to pivot. Is there awareness that venture capital, follow-on venture capital finance may not be as easily available, so the angels might have to do further rounds of funding, so they need to conserve their finance. And of course, there's less opportunity to exit, so angels will have kind of less capital gains to reinvest. So I think for all these reasons, most angels are pretty cautious in trying to preserve their angel investment cash for their existing portfolio. Some, of course, are investing, they're publicly saying they're investing, probably a minority. They're looking to make new investments. But of course, what they're looking at primarily is businesses that are addressing COVID-19 related opportunities of some of the kinds we've heard earlier. Moreover, it would appear that only a small minority of angels have stopped making investments. Some are simply stepping back to watch and wait, and some who have been disparagingly called tourists, who come in, dip into the market, do a few deals and step out. They're the ones who are most likely to have dropped out. The nature of angel investing is also changing. Everybody talks about lower valuations, particularly at the seed and startup stage. Particularly at the later stage, less so at the seed and startup stage. Now, this has implications for angels who've invested pre-COVID. If they're seeking kind of follow-on funding from VCs, the valuation will be much lower than they might have anticipated. So there's a risk of lower valuations, down rounds. And this is precisely what happened 20 years ago in the aftermath, in the dot-com crash. I was doing research on angels at that time, and that's what precisely happened then. And a lot of angels were seriously damaged by down rounds that VCs imposed, and many of them stepped away from the market. Indeed, that was why that was a driver for the emergence of angel groups, because angels realized after that experience that they needed strength in numbers and they needed deeper pockets, so they could do follow-on funding rounds rather than doing one round and then going to the VCs. There's also lower exit valuations as well, the smaller rounds. And so the overall consensus is that angels will be investing less over the next 12 to 24 months. So this suggests that governments must act. A quote here, I think from the same Sifted article by Jenny Tooth of UK BAA. Unless the angel ecosystem, which as she says puts a significant amount of money into into entrepreneurial businesses, unless the angel ecosystem receives a boost, we will have a massive hole in the ecosystem going forward. And so somebody, I'm not quite sure where the second quote came from, the same article, Government must act now to incentivize angel investors to invest in businesses that have been unable to secure sufficient funding to avoid losing a huge cross-section of the UK SME sector. Indeed, some of the commentary is concerned that several years of building entrepreneurial economies will be lost over the next few months. So what can governments do? Well, first thing perhaps is to increase grants and other non-dilutive sources of finance. Inject money into businesses to enable them to kind of get going before having to sell equity. This reduces the early dilution for entrepreneurs. It also makes the businesses more investable for angels, because they'll have got some of the product development going. Co-investment schemes are obviously quite popular in many countries. The idea being that the government co-investment fund will invest alongside the business angel, leveraging the angel's own due diligence. The fact that angels have got skin in the game means that the government don't need to kind of do the due diligence as well. Typically, they're on a 1-to-1 ratio. One euro of angel money is matched by €1 of government money. There's debate about whether that ratio should be changed. Maybe €2 of government money for €1 of angel money. There's also a concern about entrepreneur businesses being overloaded by equity, having to sell too much equity. So there's certainly been a discussion about the need for convertible debt instruments to reduce dilution for entrepreneurs, or delay dilution. And of course, tax incentives for angels to change the risk-reward ratio. And again, every country virtually has got tax incentives. The design of these schemes varies in terms of how much tax relief there is. One of the issues, certainly in the UK, is that most of the investment under the EIS and the SEIS happens towards the end of the tax year, from January to March, because that's when angels are figuring out their tax. I would argue what we need to is somehow bring the 2021 EIS and SEIS investment forward in the tax year. So they're happening in Q1 and Q2, well, Q1 and Q2, rather than waited to Q4. So that's an issue. But critically, the devil is in the detail. It's the design of these schemes that are critical for the success, particularly what is an eligible business, and also how these schemes are delivered. There's been a lot of debate about the UK's Future Fund, which is a kind of convertible debt scheme, a co-investment convertible debt scheme. Well, there's been a lot of criticism about that, not least that angel investors can't access the EIS and SEIS on the scheme. So these are the things that government can do, but I say it's the design and delivery issues are so critical. One final thought prompted by the panel discussion. Somebody, it's a truism, the best kind of finance for an entrepreneur comes from customers. And something else I think government can do is adjust the procurement to open it out to startups and early stage businesses so that they can more easily and more quickly serve government. Maybe at the end of the day, that's the most effective thing governments can do, to buy from entrepreneurial businesses rather than just providing them with subsidized finance. So thank you very much.